On February 28, 2026, everybody is staring at one number for silver, $100. But the banks? They're terrified of a much smaller number, $75. $75 isn't some random resistance level on a chart, it's a kill switch. If silver holds above $75 through the March 2026 delivery window, it triggers a chain reaction in the options market that the bullion banks cannot easily stop. Traders call it a gamma squeeze. You've seen this movie before with GameStop and AMC, options forcing the hand of the big players. The only difference now is, back then, it was meme stocks. This time, it's one of the most structurally suppressed physical assets on the planet. RateScope here. Today we're going to walk through why $75 is the line the banks don't want silver to hold, how the options market quietly loads the fuel for a move, and what the charts are telling us about a potential vertical move into March. No hype, just mechanics. Most people see a silver price and think, buyers and sellers met there, end of story. The options market tells a much deeper story. Here's the simplified version. A call option is a bet that price will go up above a certain level. The seller of that call is betting it won't. In silver, many of those sellers are bullion banks and large institutions who happily collect the premiums. They sell calls at strikes like $75, $80, $85, thinking silver will stay below those levels, or at least not spend much time above them. Now enter gamma. Gamma is a measure of how quickly an option's delta changes as the underlying price moves. In plain English, as price gets closer to the call's strike, the option behaves more like the underlying asset itself, and the seller's risk grows non-linearly. What do banks do when their risk grows? They hedge. If you've sold a massive amount of $75 calls and silver climbs from $70 to $74 to $76, your risk that those calls finish in the money goes up. To avoid being naked short, you start buying futures, buying physical, or both. That's the gamma trap. Price rises toward key strikes. Call sellers buy silver to hedge. Their buying pushes price higher. Higher price increases their option risk again. They're forced to buy more. It's a feedback loop. As of this week, open interest in the $75 to $85 call range is at a 5-year high. That tells you there are a lot of bets that silver will not cross and hold those levels, and a lot of potential forced buying if it does. This is why the banks care about $75 more than the meme target of $100. If price gets through $75 and stays there, their options book becomes a bonfire. Let's put some rough numbers around this. Imagine there are tens of thousands of calls open between $75, $80, $85. Each contract represents 5,000 ounces of silver. If banks are net short a big chunk of those calls, and delta on those options rises as spot grinds up, they might need to hedge tens of millions of ounces just to stay neutral. But we already know. COMEX registered inventory is historically low. Physical supply is tight. Arbitrage is pulling metal east. So every time they go to the market to hedge, they're competing with funds, stackers, industrial users. Their own hedging demand becomes fuel for a squeeze. This is what a gamma setup is. Price sitting just below a wall of call strikes. Sellers hoping price will reject and fall back. Buyers pushing against that wall. And if the wall breaks, volatility explodes. That's where the $75 level comes in. Now look at the chart. Early February, silver gets smashed. Fast move down, leverage flushed. Social media screaming, bull trap! But what happened next? A relentless recovery. Roughly a 32% move off the lows. Quick enough to catch shorts off guard. Controlled enough to build structure on the way up. On the daily time frame, you can see something forming that every technical trader recognizes. A cup and handle. The left side of the cup, the pre-crash highs. The bowl, the pullback and recovery. The right side, price returning to near prior highs. The handle, a smaller pullback consolidation above a key support. In this case, that support is near $75. For the pattern to stay valid, the handle needs to hold above that support area. Put in higher lows. Squeeze out late shorts who are betting on a breakdown. If that happens, the next leg is usually not a gentle stroll. Cup and handle breakouts tend to be fast, directional, and often overshoot traditional targets. For silver, that breakout zone points toward $92 as the next major stop, and above that, the psychological magnet at $100. While this is happening on the chart, the term structure of the market is sending another signal. We're seeing signs of backwardation, where spot is trading above near-month futures. That's the market's way of saying, I care more about having metal now than a promise of metal later. Backwardation is rare in healthy, well-supplied markets. It appears when near-term demand is intense, or near-term trust is thin. Combine a cup and handle forming above $75. Options open interest stacked between $75 and $85. Signs of backwardation and physical tightness. And you start to see why this zone isn't just another level. So where are we right now, really? We're in a short covering rally. The first wave of buying was shorts closing out positions that went against them. Algorithmic strategies flipping from short to neutral. Some funds pressing momentum. That's the fuel we've already burned. But there's a second wave that hasn't hit yet in size. The industrial giants. The long-term allocators. The we don't care about this quarter, we care about the next decade money. Those players are watching the same things you are. COMEX stress, Eastern premiums, trade war chaos, energy and tech demand. They're not trying to time the last dollar of a dip. They're trying to avoid being stranded without metal or being forced to pay absurd premiums later. If silver holds above $75 this week, the cup and handle structure is intact, the options market pressure increases, and the technical case for a gamma-style squeeze into $92 to $100 strengthens. If we lose $75, we risk a deeper consolidation. The banks get more breathing room. The breakout is delayed, not destroyed. So the real question isn't just, is silver going to $100? It's, can silver hold $75 long enough to force the options market to do the buying for you? What should you be watching practically? The daily close around $75. Intraday spikes and dips are noise. What matters is, are we closing above that zone? Are dips being bought quickly? Open interest on key strikes. $75, $80, $85 calls. If open interest stays elevated or grows while price grinds higher, gamma pressure builds. If those positions suddenly vanish, it can mean calls are being closed, rolled, less fuel, or some shorts already ate their losses, squeeze partially played. Signs of backwardation. Compare spot versus near expiry futures. A persistent premium in spot is the market shouting, I value immediate metal more than paper promises. News on industrial offtakes. Big tech companies locking in mine output. Long-term supply deals. These deals don't move charts instantly, but they drain the future pool of available silver. And then the most personal piece, your own plan. Are you buying every dip blindly? Are you waiting for a confirmed breakout? Are you leveraging with options you don't fully understand? This channel is not here to tell you, back up the truck or sell everything. It's here to make sure you understand the mechanics, you see the risk on both sides, and you don't get wiped out by a move you didn't see coming. We're in a market where charts matter, options matter, vault data matters. Ignore any one of those at your own risk. Are you watching the candles and the calls? Are you watching the premiums and the physical flows? Or are you just watching the price on your phone and hoping? Let me know in the comments. Are you buying this dip into the $75 zone? Or are you waiting for a clean breakout over $80 or $92 before committing? Subscribe to RateScope if you want the next layer of this story, because the closer we get to March expiry with silver parked above $75, the louder the options market will start to scream. And when that gamma switch flips, you don't want to be figuring out the rules while the chart goes vertical.